In this video, I'll share my A+ setup checklist. I go over the checklist before entering any trade to ensure that I'm only entering high probability trades. I guarantee you a higher win rate if you follow this checklist. This is Mulham and let's get into the video. Starting with the first checklist, and it is a higher time frame point of interest. So basically what I want to see, the current price needs to be inside of a higher time frame point of interest. The probability of your trade when you are inside of a higher time frame point of interest is much higher than trading inside of random areas on this range. So if you enter a trade here, the probability is much lower. If you enter a trade here, the probability is much lower. Also here, the probability is lower. But when price comes inside of this higher time frame point of interest, the probability is much higher, and you could catch either expansions, you'd be catching explosive moves and sniper entries from here with a high reward to risk. But when you trade not inside of higher time frame point of interest, then you'll be catching only small moves, and a lot of times price will hit your stop loss. Types of point of interest could be fair value gap, inverse fair value gap, order block, breaker block, highs and lows, and there's some other point of interest, but I really suggest sticking with fair value gaps and order blocks because those are the highest probability ones. Now you could also deal with highs and lows, right? So this high in the future is a point of interest. When swept, then the probability of this trade playing out very nicely is much higher, and the same here. So higher time frame point of interest, we need a one that is bullish in order to find a lower time frame entry, and we're going to be discussing this later. But the higher time frame and the lower time frame needs to be aligning with each other. So a bullish point of interest on the higher time frame, then I'll be looking for a bullish entry on the lower time frame. That's all. Looking at this example in the 4 hours, so basically if we go from 4 hour to 15 minutes, then at those levels, you see how if we enter a trade on this range here, we're going to be stopped out a lot and there is no expansion move. However, when we comes to this point of interest, which is this fair value gap, and we enter a trade here, the probability of trades playing out on my side is much higher, and you can see get an expansion to the lower side after price coming to this fair value gap. So entering here on the 15 minutes, the probability here is much higher, and the same thing goes here. Price back into the fair value gap with a sweep, price coming lower. So you see how if we get an entry from here, it's much higher probability than just entering randomly on this range, not from a higher time frame point of interest. The same thing here. Very nice respect going all the way here. Now this is a low. So a point of interest could be a low, right? And we could see a sweep here, price going up into where? A fair value gap. So I'm only going to be looking for entries at this fair value gap, at this fair value gap, at this low, at this low, and at this fair value gap, at this order block, at this order block. So it's always like this. This is how you could be minimizing your number of trades, but getting a higher win rate. That's how you do it. You always take entries from a higher time frame point of interest. If the price is not on a higher time frame point of interest, then forget about it, because it might hit your stop loss. It might not give you a good reward to risk, and simply consider it not an A+ setup. Our sponsor, Blue Guardian, is the only firm that gives you a tool to protect yourself from hitting your max daily loss and prevent you from overtrading. And it is very simple to use. They also have a new unlimited time evaluation with low profit targets and no trading days requirement, so you can get funded in the same day. Blue Guardian is a firm that I trust. Use the link in the description below and use the code MOLHAM to get 10% off your next Blue Guardian evaluation. The second setup is there should be an inducement on your trade. So basically, we have this higher time frame point of interest. So we discussed that we want to see a higher time frame point of interest in order to say that this price, in order to confirm that this is an A+ setup. Now, this is your high time frame point of interest. Institutions needs to have this inducement, or now basically we want to see an inducement. What is an inducement? It's basically a liquidity level that is in front or close to the higher time frame point of interest. And why is that? Because institutions need those highs or lows, in this case a low, in order to enter the trades without a high slippage. Because when prices come in lower, if prices come in here into the point of interest without having no liquidity here, then it's going to be much harder for institutions to execute here. But when we have this liquidity, then liquidity is taken here into the point of interest, and now institutions have the ability to enter their trades with their big lot sizes and no slippage. So simply, higher time frame point of interest, I want to see a liquidity either above the point of interest in this case, or inside of it, kind of inside of it, or partially inside of it. It could be equal lows, it could be a trend line liquidity, but any type of liquidity that is in front of the point of interest. This way, we can confirm that this point of interest is now much higher probability. It's not any point of interest, but we always focus on the high probability one. Now, looking, for example, at this point of interest here, we can see price reacted aggressively here with a displacement and a fair value gap. And we can see that this fair value gap here has a liquidity that is inside of. Then where do we enter? This is our entry. And why? Because now we have a point of interest and we have a liquidity that is in front of it, or in this case, inside of it. Then that's a higher probability one. The same thing goes here. So price respected this. This is where we should enter. Now price is coming lower. This is a point of interest. Where do we find our inducement? We can see that this is now an inducement, and it's also a session high in this case. This is London session high. This is an inducement. It's simply a high that is inside of a point of interest, and then it's taken here, so we can actually take an entry here. It's always better to wait for an inducement to be created and then you enter from. The same thing goes here. So we created this point of interest. Did we have an inducement in order to be taken inside of that fair value gap? Yes, this is a low that has a fair value gap below. Then this is a point of interest that has an inducement. Price came here, taking the inducement into the fair value gap, and then started going up. This is the highest probability type of entry you're going to be finding. And that's how you can actually confirm and distinguish between a high probability point of interest and a low probability one. The third checklist is a breaker structure and drawn liquidity. So basically, we're looking at this point of interest and we have the inducement. What I want to see, and this is something that I don't look for every time, but when I have it, it adds another confluence to my trade. Basically, I want to see a breaker structure that happened before the creation of the point of interest. If there is a breaker structure, it at least gives me an indication that the order flow and the market structure is going to the upside. It's going with the direction of my higher time frame point of interest. So prices coming lower after the breaker structure, we can always anticipate this dealing range from this low to this high to hold, and then we go up. And most of the time, when we are coming lower in this case, we are having an external to internal move and then internal move to external. So we can always know that if we're coming here to this internal, which is the fair value gap, then we are going to the external, which in this case is the high. And a lot of time, this would be a market maker's model. So an indication, therefore, the understanding of the drawn liquidity and the high and the internal to external and external to internal will tell you which high to target or which fair value gap to target. And a lot of time it's going to give you an indication that we are having a market maker's buy or sell model in this case. And there you go, a breakout structure here, point of interest here. We always had that internal to internal here. So we could always enter here on the lower time frame targeting the high, and that's going to give you a huge reward to risk. So I always want to make sure that am I going internal to external or internal to external when taking any trade. We can see in this case that I was looking at this point of interest, right? And what I saw is that we were having a displacement above an old high. And in this case, this is a breaker structure. And my dealing range is from this level, right? This one here to this level here. So this is my dealing range. This is a point of interest inside of the dealing range. And I can see breaker structure here, price is coming back into the point of interest. So now we're having the external to internal, and then from here, internal to external, always targeting the previous high. And it repeats over and over. Now we have another breaker structure here. So this point of interest is going to be much higher probability when having this breaker structure. So price is coming lower to the internal liquidity, in this case, a fair value gap, and fair value gap entering from here, going where? Always to the external liquidity. There you go. Another breaker structure to the upside. Now again, looking for any point of interest on this dealing range, or it could actually take this low again, right? We could have this turtle soup here. So understanding of internal, external is going to always give you an indication, as I said, of a market maker's buy or sell model, as well as knowing what level to target. Is it the liquidity level or is it the fair value gap inside of the dealing range? And now we're done with the higher time frame part. Now we're going to go to the fourth checklist, which is the lower time frame confirmation. So basically, when price comes into the higher time frame point of interest and I wanted to have a previous breaker structure, I wanted to have an inducement, then I want to see a lower time frame confirmation a lower time frame pattern or an indication in order to enter the trade. I'm not going to be blindly entering from the higher time frame point of interest. I want to see something to happen in that higher time frame point of interest. Now, the first type that we could actually look at is a change in state delivery. So basically, I want to see prices going up with bullish candles and then an engulfing candle or multiple candles going to the lower side. And in my opinion, and people have different opinions on changes to delivery. It was not really explained in a specific way. That's why people are being different on this. But my way of looking at it is change in state delivery is basically the creation of an order block. So basically price is going up, right? And then this is the last bullish candle. Then we got this bearish candle inside of the higher time frame point of interest. This way, when we have this engulfing candle going and closing below this candle or closing below multiple candles to the lower side, when this goes down here, then it created this bearish order block, which could now price come back to it and respect it. So sometime I do enter on the creation of this order block, which is in my opinion the change in state delivery. Now this is one type, but this is too risky. There is the market structure shift, or what is called by others change of character, right? We can see prices coming into the point of interest, sweeping a lower time frame liquidity and breaking below this low, closing below. That's your market structure shift right here, right? And then you enter from a fair value gap here, or the order block in this case. Now, there is another entry which I teach and I do take some time, which is simply the first fair value gap. So I'm in this higher time frame point of interest, and you guys know that the creation of a fair value gap tell you a story, and the lack of fair value gap tell you also a story. Now we can see that prices going up, coming lower, creating a fair value gap in this case. This fair value gap, when I see, I could enter from it immediately, even if there is no market structure shift, even if there's nothing. But this first fair value gap is a very high probability one. And if you watch my video about the fair value gaps, the high probability one, then you would know that this is actually the second fair value gap if this higher time frame point of interest is the first one, right? So this would be the first one, and this would be the second fair value gap after price respecting the first one. So this is a very high probability one. So if price comes back to it, you could actually use this as an entry. And this is my lower time frame confirmation. Now, looking at this, for example, let's consider this liquidity sweep here. So liquidity sweep happened here with a wick. And as you guys know, a wick with a wick, liquidity sweep is a very high probability one. We can see that this candle closed below this candle. And this is a bearish candle, which creates this as an order block in the future. And then there is a fair value gap also created here. But where is my change in state delivery level? It's basically this candle low, because this is the last bullish candle. Then price closed bearish. And as you can see, 1, 2, 3, 4. 4 bullish candles, and then there is the fifth one that was created after the liquidity sweep. So we know that this level is very significant. So this is my change in state delivery, and this is my first fair value gap. Price did not come back to the fair value gap, but if you take this change in state delivery entry, then that's going to be a successful one. Now again, price coming lower, liquidity sweep here, or if you consider this one, liquidity sweep here, and then where's your change in state delivery? You can see that this is a bearish candle. We got this bullish candle, but it's very weak. And then this bullish candle closing above this. This is my change in state delivery. And we have a very small fair value gap that also price comes to. And we have this order block that also price comes to. You see how this candle closing above the previous candle, it created this order block for us. This order block here. And then this order block was after respected. Now price is going up again. We could see that we have this big liquidity sweep here, or this now this big liquidity sweep, you see how price is coming up, give us a mitigation of this fair value gap before price take the main liquidity level. Now it's going up, and we can see bullish candle, bearish candle, but it's not that bearish, it's just an inside candle. And then bullish candle, and after taking this liquidity level, we see this big bearish candle, which in this case, it creates this order block for us. This is an order block, and you see price come back to that order block and then started coming lower. So the change in state delivery happens even before a market structure shift happened. You see, market structure shift is closing below the last low, which is right here. But you could have already entered using the change in state delivery right here, but this is more risky. And then price basically coming lower. Very nice entry, and this is how I do it. So you could, use any of those entries or use the one that fits you more. You could actually, after price taking the main liquidity level, let's say this is your liquidity level, price could come lower and give you another 2022 mentorship model. Simply, price could do this and then enter from it. So a lot of different ways to actually use the lower time frame confirmation, and feel free to follow your way and the way that fits you and fits your personality and your account. Now, one thing to understand, and it's very significant in trading, and sometimes the fifth checklist, and it's a very significant one and it's very important one. It's low resistance liquidity run against high resistance liquidity run. Basically, when we want to enter, we want to see a high resistance liquidity run. What we want to target is we want to target low resistance liquidity. That's all what we want to see, right? So basically, what is a high resistance liquidity? It's the sweep of liquidity. When we have a sweep of liquidity, for example, here, we can see that this high was swept, price coming lower. This is a high resistance liquidity run. And now we have high resistance liquidity. What does that mean? We have liquidity here and we have less liquidity here. In this case, in a low resistance liquidity scenario, what we're having is a failure swing, basically, or a trend line. We could have multiple highs here, and this is going to be a trend line. In this case, this is what we want to target. This is our target. So I want to see a high resistance liquidity targeting the low resistance liquidity. This high resistance happen here, then I want to go short targeting the low resistance liquidity. That's how we want to do it. So basically, enter on the high resistance liquidity run, which is the sweep, and targeting the low resistance liquidity. When we are targeting the low resistance liquidity, we're going to be having a lot of displacement. We're going to have price will hit our take profit much, much faster than targeting high resistance liquidity. You don't target high resistance liquidity because there is no liquidity already, or at least there's much lower liquidity. When we are in a low resistance liquidity, we have liquidity here and we have much more liquidity here. And then another failure swing here, we have much more liquidity, much more, right? A very easy example of this is we had this high resistance liquidity, which is liquidity taken here and then price coming up. And then what do we have again? Another high resistance liquidity. When you see those high resistance liquidity, know that this is your side and this is your bias, which is going to the lower side. Why? Because it's always opposite. Because it's always opposite to the high resistance liquidity. So if you see a high resistance liquidity here, then know that your direction is going to the lower side. Why? Because the high resistance liquidity run happened on the upside. Now we're going to go lower for the lower resistance liquidity. Now we see high resistance liquidity run again 2 times. Now we're coming down, right? Now we're going low. We created this fair value gap and we can see that there is another high resistance liquidity run here. Now, where is my low resistance liquidity? Basically, we have liquidity here, more liquidity here, a failure swing, and another failure swing, which created this trend line liquidity. And we know that trend line liquidity is a good level to target. So basically, liquidity here, more liquidity because it was not taken, and more liquidity here because also it was not taken. And then you see the displacement after price taken, or filling this fair value gap. You see the displacement that happened here? Literally one candle that took all of those low resistance liquidity. So always when entering any trade, make sure that you are aligned with the low resistance liquidity. And we can see actually a very nice market makers sell model on this case, right? Simply original consolidation here, and then the reaccumulation, and then price coming lower and taking all of those levels, right? All of those levels were taken with a single candle, literally. Now, at the end, covering 2 extra checklists, and they're very easy one, very simple ones, but I make sure that I follow them. The first one is that my trades needs to be in kill zones. So either the London kill zone or the New York kill zone. Simply, I don't take any trade unless it's in the kill zones, right? London kill zones 2 to 5 a.m. and New York kill zone is 7 to 10 a.m. all Eastern time, New York time. And then the reward to risk needs to be worth it. For example, I don't take trades that are less than 2.5 or 3R. Or at least if the low-hanging fruit is not 2.5 or 3R, then I don't take the trade because it's not worth it for me. So always have those rules in mind and make sure that you follow them. That's the end of the video. Make sure you guys to join the Discord that I have. It's a free Discord. We do live trading and we do a lot of educational seminars there. So make sure to join the Discord. Make sure also to share this video with your friends who think that they need this A+ checklist, as well as hitting the like button, and leave a comment about any of the topics that you want me to cover next. Okay. And I really wish you the best. This is Mulham, and I'll see you in the next video.